I think the market had a lot of challenges. One, in October, I would suggest that most markets, including some resource markets, were getting close to priced for perfection. Perfection, of course, seldom occurs. But we also had two other circumstances. One, interest rates on a global basis, but particularly in the United States, rose and rose fairly rapidly. Rising interest rates do a few bad things to equity markets. They increase the various companies' cost of capital,
Yep.
which decreases margins. They also lower the capitalized value of distributions, dividends, relative to other savings products. And in certain economies, they can lower consumer demand. So we had really a trifecta around an increase in interest rates. And on top of that, just to throw another spanner into things, the world decided to have a war, a fairly localized war now, but a war that, among other things, pointed out real fragility in supply chains around the world. And I think that war in and of itself probably has caused people to be nervous. The result of all that is that what had been euphoria changed to caution. And I think the decline that we've seen in equities markets doesn't yet reflect a rout, but it certainly reflects the fact that the outlook that we see today is much less rosy than the outlook that we were seeing in October.
When you say it's much less rosy, I guess one of the areas that I wanted, you spoke about the war. Right now, here in Australia and globally, I believe, we are facing an energy crisis. That is unprecedented. And what I'd like is your views on how that might play out in various commodity markets.
Well, remembering back to the 1970s, it takes a while for the higher prices engendered by an energy crisis to moderate demand and increase supply. And that will have to happen too, particularly with regards to oil and gas, but with all energy sources. They are capital intensive and they're permitting intensive. Imagine now if somebody wanted to build a new refinery on the east coast of Australia.
We don't have any refineries left.
Yeah, so imagine the permitting requirement, never mind the construction time. It takes a very, very, very long time to have the high prices that we're currently experiencing now become reflected in a market. On top of that, the big thinkers in the world, the politicians, including your own, are anti-fossil fuel. Mm-hmm. The result of that is that despite the fact that operating margins in both the refining side of the oil and gas business and in the upstream E&P side, despite the fact that those margins are at almost historic levels, the oil and gas business on a global basis is underinvesting in new project and sustaining capital investments to the tune of about $1 billion a day.
A day.
The political climate, a day. The political climate is such that the oil companies are afraid that to the extent that they invest or want to invest, that they won't be able to permit. At the same time, large investors around the world look at the political winds around oil and gas, and they're asking the companies to decapitalize. They're asking companies to return capital to shareholders rather than invest in the business that's created the money. So the circumstance that we have in front of us is one where normal economics are further constrained by, if you will, sociology and politics. Energy policy is not set by supply and demand anymore. It's set by the big thinkers of the world, the Bidens, the what's his name, the famous energy economist, Greta Thunberg, that's it, the noted Swedish energy economist, and people like that. And what could possibly go wrong?
What could go wrong?
Having the political class establish energy policy. Now, it is true that we would get some respite from this, some fairly immediate respite from this, if the Russians and the Ukraine found a way to give each other an off-ramp. Part of the dramatic increase, as an example, in seaborne liquefied natural gas has to do with the fact that Russian gas is less available and less transactable to Europe. And the consequence of that is that seaborne shipments that used to go everywhere seem to be going to Germany, and Germany.
Right.
Two, in the uranium side of the business, there was an immediate spike in the uranium price, since settled off some, reflecting the fact that Russia controls about 40% of the world's enrichment and re-enrichment capacity, a business that Australia should think about getting in. Were we to have a circumstance where peace broke out, I think that you would find an immediate softening in energy prices, in ammonia prices, nitrogenous fertilizer prices, potash prices. I'm not smart enough to tell you if peace is at hand. It doesn't seem like it right now, but I think there would be a respite to the panic buying that you're seeing in numerous commodities. If we don't see peace, though, I think the fragility in the supply chain might become very pronounced. If you look, as an example, at the percentage of the market share that Russia and the Ukraine currently enjoy in the wheat market,
Yeah.
in the near term, that can't be made up elsewhere. It just can't be made up elsewhere. And to the extent that the Russians are forced to divert more time and treasure nationally to defense or offense, depending on your point of view, they will be less able to invest the sustaining capital investments needed to maintain their own production of natural resources. The consequence of that is that if the war went on a year or a year and a half, what you would find at that point in time is if the Russians were allowed and were of a mind to resume shipments, they would be able to ship substantially less.
Which leads me to the fact that there are going to be some supply constraints. And we noticed that India recently banned the exporting of wheat. So there are going to be even more constraints, which brings me along to the inflation thematic, because that will have an impact on commodities globally, won't it?
One would think that it might. The nervousness that you have around this is that one possible offshoot of this war and of the instability surrounded by war and the lack of confidence around the war would be a global recession.
Yeah.
In other words, it might be that ill spirits move from financial markets to markets generally. And the consequence of that might be a global recession or a depression that all the big thinkers and all the liquidity in the world couldn't solve for a while. That would, of course, decrease commodity prices. Commodity investors are in a very interesting circumstance. If the world doesn't have a recession or depression, there will be, given the current levels of capital investment, widespread shortages in supply in the next 5 years. Widespread in copper, in oil, in natural gas, despite the Indonesians' best efforts, in nickel, across a broad range of industrial materials. On the other hand, if there is a demand shortfall, it could be that supplies are adequate to meet diminished demands. I'm no big economic thinker. I talk about economics because I have to, in terms of what I do around my own portfolio. But investors need to think about both sides of that equation.
How do you think about both sides of that equation when it is so uncertain? We don't know how long the war is going to go on. I mean, President Putin is looking increasingly like he's losing a little bit of touch there, but we don't know. We don't have a crystal ball. So in this time of volatility, what is Rick Rule doing to ensure that he protects and potentially grows his wealth?
Given that I don't know, what I try to do is invest and speculate in what I see as a range of probabilities. My belief is that the best resource companies in the world will weather any potential storm and prosper should there not be a storm. And I try to look at companies that have durable competitive advantages. In the case of juniors, as an example, I try to look for companies that have tier one deposits, deposits that will have a market almost irrespective of the state of commodity markets. In the case of bigger companies, I look for companies that control deposits that are in the best quartile worldwide in terms of return on capital in the world, and also in the lowest cost quartile worldwide. When I can, I look for companies that have reasonable track records with regards to overall corporate return on capital employed, which is to say, companies that can reinvest cash flow during flush periods like this now to in fact grow their production base. That's a fairly rare group of companies. And by constraining my own investments to either investment grade companies that are best of breed or speculative explorers that are in their own context best of breed, I seem to be able to weather bear markets and prosper in bull markets. There would seem to be a different class of speculator and investor whose deployment methodology would seem to be got a hunch, bet a bunch. It's difficult to imagine a scenario where that group would do well.
What you're saying is that there's too many people out there that are what we call gambling because they don't actually do any research. They just hear that this is the next big thing. I guess you could almost say that to the crypto market, that people just are piling in without fully understanding what even cryptocurrency is. And it's the same with commodities.
Well, certainly the thing that kept me out of crypto is I have no particular interest in investing or speculating in a subject where I don't feel that I'm competent, where I don't have any competitive knowledge advantage. And crypto almost describes that for me. You know, when I look at certain circumstances out there, Carrie, the global oil and gas business would be one. Yes, the easy money has been made in the move from $20 US a barrel to whatever it is today. But the truth is that the major oil company major producers worldwide, including Woodside and Santos in Australia, are selling at price net asset value ratios that would suggest that the oil market was at 65 or 70. And would suggest too that the natural gas market was closer to $4 per million BTU than $8.5 or $9 US per million BTU. Now, it isn't impossible to believe that those price levels could be violated on the downside in the event of a recession or a depression, but I think it's unlikely. And if you have a circumstance where there's an industry that is as determinedly out of favor as the oil and gas industry is, one that is as cheap as it is, one that generates as much free cash as it does, one that's polite enough to return a lot of that cash to its owners, which is to say the shareholders, and one where perversely the whole political class is making their business better by constraining new investment and maintaining higher prices for longer. I mean, it's odd to see Greta and Biden as the champions of the oil and gas business, but in some senses, that's what they are with existing production. I think that while there's no certainty in life, the probabilities around doing well, buying the best of the best oil and gas producers, and enjoying, by the way, very handsome dividend yields compared to other income levels that you could get, is a pretty good thing.
Yeah. Do you think that there is this move, I guess, politically, and we are, in my opinion, overgoverned globally? So many politicians with their nose in the trough and turning around and saying, we must go this way. There is that sort of move to the zero carbon emission world that they all want us to live in, which brings me quite nicely to one of your favorite topics, which is uranium. Now, the uranium market, although it did start to have a little bit of a move and started to have some momentum, it seems to have settled a little bit. I'd love your views on where you think, I mean, we are in an energy crisis. Uranium is a great fuel source and it's zero carbon. What's your views on where the uranium market's headed?
I think uranium's a no-brainer. I've had the good fortune of being interviewed by you many times. And so there are points in time when I think that the uranium stocks are ahead of themselves, that the narrative has overrun the reality. And there are other points in time. I mean, the uranium investor is a manic depressive, it would seem. We're in a circumstance now where, while the uranium price may have $2 or $3 downside, US dollars per pound, it probably has $30 or $35 upside. And if I look at my downside, let's be generous and say my downside is $5 US, and my upside is 30 or 35. That's a pretty good juxtaposition of risk to reward. Now, I monitor 75 public uranium companies in the world.
Wow.
And I can, at the right price, only buy 12 with a straight face. In other words, there's too many pretenders in the space. But I think if you focus on those companies, and in particular, if you focus on those companies in days when equity markets, tertiary equity markets, speculative equity markets are getting crushed, that it's a wonderful place to be as a speculator. Particularly wonderful with the spot price of uranium falling in the face of, as you say, attractive political wins around non-carbon generating baseload power and around geopolitics. Japan became the second largest consumer of uranium in the world as a direct aftermath of the Arab oil embargo in 1975, when the geopolitics of energy supply were painfully forced on Japan. The Japanese decided that they would go to a fuel that was energy dense enough that you could store enough to supply the whole country for 5 or 6 years. The only fuel that meets that description is uranium. The consequence of Fukushima and the opinion of the Japanese populace, well-founded, I believe, that their government and electric power industry had lied to them, was the shutdown of the nation's entire nuclear fleet. The twin good wins of the fact that Japan recognizes that she needs non-carbon generating power, and the recognition that the global supply chain of all things energy is very fragile.